Okay, starting now. Okay. Hello, everyone. My name is Jessica Harris. I am a director at Legal Services in Northern Virginia Low Income Tax Clinic. I'm here with Nancy Ryan, the qualified tax expert, also at Legal Services Northern Virginia, LITC, and then David Sams, who is the director at the Community Tax Law Project in Richmond, Virginia. Today, we're going to speak to you guys about the current tax issues affecting low income clients, and I will turn it over to Nancy to start our presentation. Okay, Nancy.
Thanks, Jess. Today we're going to talk about three of the more timely issues that we've been dealing with, mostly related to the coronavirus pandemic. Unlike prior years where the IRS's major job has been to collect money from the United States public, in the past 18 months or 18 plus months, they have been charged with getting payments into the pockets of the American taxpayer. So the first topic we're going to talk about is the economic impact payments that started being generated last March at the beginning of the pandemic, and how people have fared with getting them and what issues we've seen with that. And the most important issue for most of our legal services family lawyers is what to do when somebody else got your money, which is very, very common in family law situations. The second part of our program, David Sams is going to talk to you about the advanced child tax credit, which has been in the news lately and is a very timely issue, and also the IRS getting money into the pockets of American taxpayers. So David will go through, how to help your clients work their way through that system. And finally, Jessica is going to talk about various other tax benefits that Congress enacted related to the COVID pandemic that, and most of them are very taxpayer favorable. So we're not here to try to turn you into tax lawyers today. What we are trying to do is just to help you identify issues and know that we're available to help you always if you do have a taxpayer with this problem, so that this way, you can just have a general idea of where to go and what to do if there is a problem. The first economic impact payment was part of the CARES Act. Now, if you remember, that was passed in March of 2020, right after the pandemic started. And that provided that every taxpayer would get $1,200 and plus $500 for each dependent. The IRS was supposed to do this based upon either the 2019 adjusted gross income on the tax return, but since we were in the middle of that tax filing season, they could also, if the tax return was not filed yet, the IRS could look back to 2018 to find out who was eligible. The economic impact payments are what's called an advanced payment on the 2020 tax return. Normally when we do our taxes, the tax is taken out for the W-2 or whatever. We do our taxes in the spring following the close of the tax year. And then if we owe a balance, we pay it. If we get a refund, we get it all as a lump sum. An advanced payment is basically an estimate of, sorry about that. It's an estimate of what you're going to get for a particular credit, and they're paying it to you on the spot. And it's issued during the actual tax year. Sometimes things don't get reconciled correctly. So for example, if someone's income exceeded the cutoff for getting these payments, to make it administratively feasible, the taxpayers who got these payments were not required to pay it back, which is a pretty novel thing coming from the federal government to say, here's just some free money and you get to keep it. One of the limitations is if anyone on their tax return who had an ITIN instead of a social security number, no one on the return was allowed to get an economic impact payment. And this payment was not included in taxable income. As a matter of fact, none of these payments we're talking about today are included in income. They're just tax credits and they're something different. The second round of economic impact payments came out right after the holidays, and people didn't notice them quite as much as they did the first one, but they were very, very happy to be able to get $600 per person. One of the big changes for the second round of economic impact payments is that there was a court challenge in Maryland to the fact that anyone with any return that had an I-10 could prevent citizen spouses and citizen children from benefiting and getting the economic impact payments. The federal district court in Maryland said that this was unconstitutional. So for the second round of economic impact payments, Congress went along with that. And they said, okay, anybody who's eligible is a US citizen or a resident alien who can't be claimed as a dependent on someone else's return. They removed the requirement that you had to have a valid Social Security number for all individuals on the return. And they retroactively said that for the first payment, any taxpayers with someone who had an ITIN on the return, anyone who would have been eligible because of being a citizen was entitled to that payment. Well, since this was decided at the beginning of 2021, it was too late to actually issue an economic impact payment, but they were allowed to claim their payments on the 2020 tax return. Now, some people received the payments automatically. Anybody who had filed a 2019 return would automatically get their $600 for themselves and for the dependents they claimed. Anyone who received Social Security retirement, SSDI, SSI, railroad retirement benefits, and VA benefits were automatically supposed to get these the $600, even if they didn't file a tax return. They were not required to do that. The IRS for the first payments had set up a non-filer portal where people who normally wouldn't file returns could file for the economic impact payment. And if they had done so during 2020, and at least before the cutoff of 11/21, they were automatically getting the $600. And then anybody who submitted a simplified tax return that the IRS had processed. So this would include, in addition to the non-filer portal, and instead of doing that, people could actually do a tax return and either electronically file it or file it by paper, and as long as it had been processed, they would automatically get the $600. Those payments came out the first couple of weeks of January. If they didn't get it, then it could be claimed as the recovery rebate on the tax return. So for those of you who did your tax returns this year yourselves, you were asked, what did you get for the first return? What did you get for the second? You put all your information on, your kids' information, your Social Security numbers. And if you did it with software, it was automatically calculated to make sure that you got the right amount. Each payment had different rules as far as who gets it, and also different rules as to what the refunds could be offset for. Normally, when the IRS owes a refund, if someone has a past due tax liability, the IRS does not issue the refund. They use the money to pay the past due tax liability. For people who owe all sorts of other debts, both state and federal, there is something called the Treasury Offset Program. And the Treasury Offset Program intercepts tax refunds that are issued by the IRS and will send the money to certain categories of debt that are listed in the statute, which would include state tax liabilities, child support, federal student loan payments, and any other federal debt, pretty much. Okay. For the first payment, Congress put in the CARES Act that the only reason the economic impact payments could be offset would be to pay child support obligations. That gave rise to a slew of cases where the IRS initially would handle joint returns where only one of the taxpayers owed the child support. The IRS was taking the entire refund and sending it to the child, or not actually it was the Treasury Department. The IRS would issue the refund, Treasury would intercept the entire thing and send it for the past due child support. So all of our low-income tax clinics had a lot of frantic new spouses or non-liable spouses coming to us to help us get them their money back. It took a while, but fortunately the IRS eventually was able to figure out a procedure where you could claim the money back by sending in it's called an injured spouse form after the fact. And they sorted things out and were able to return the money to most of the people, at least half the refund, the non-liable spouse's refund to the taxpayer. But we still see people who have not, whose refunds for last year were intercepted that are entitled to get this money back, and we will help them do that if they need if need be. To avoid these further problems and also to stimulate the economy, the second payment, the $600 payment that came out in January, could not be offset for any reason, and the third payment could not be offset for any reason. One problem or one inequity is if someone did not get the economic impact payment, but they had to claim it as a rebate recovery credit on their 2020 tax return, legally that could be offset under the Internal Revenue Code. So the first half of the tax season, the computers automatically offset whatever credits were claimed, but halfway through, the IRS changed its policy and opted not to offset for past due taxes. But they had no control over the Treasury offset program because that's done in Maine Treasury by the, what's the name of the office? Bureau of Fiscal Services, I think. That's who does it, David? Thank you. David's nodding. The Bureau of Fiscal Services administers the Treasury offset program. So this created a ton of confusion because it was publicized that the IRS was not doing offsets, but anybody who owed money, who was getting a refund and thought they would get it, who owed any of these other categories of debt that was covered by the Treasury offset program, their refunds were swiped and turned over, and there was no remedy for that because IRS couldn't fix it, we couldn't fix it. They just owed that debt, and unless the other agency was voluntarily not taking the money, such as the student loan program, that they were out of that money and there was no way of getting that back. The third payment, I thought we had a third payment slide. Okay, there was a third payment, all right? The third payment was not part of the 2020 tax liability. It was $1,400 per person, and it covered a wider category of dependents because the prior payments, the dependents had to be child dependents who were 16 or under, and they were the only ones who qualified. There was an expansion of the category to non-child dependents to qualifying relative for IRS purposes, which includes children over the age of 18 who are going to college, disabled children, parents, and anybody else who you provide for more than half support who you claim on your tax return. So the payments were $14 per person, and those were issued to most people in March for the people who had filed the 2019 return. Once the 2020 return was filed, there was the reconciliation of the first two payments, and that would also generate the third payment automatically for people. Okay, so what dependent, who gets to claim these dependents? We're getting starting to dabble into the family law area here because I'm sure your organizations and ours, we all see double people trying to claim the same child in family law situations. So the rules to have a qualifying child is right now there is something called a relationship test that says the child must be your son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them. But there does have to be a relationship, either a natural familial or legal relationship, such as adoption, if it's a stepchild, that's fine. The child must be under the age 19. They can be under age 24 and a full-time student, or any age if permanently and totally disabled. And it has to be the taxpayer's child. Okay, it has to be younger than the taxpayer. It's very rare to see it that they're older, but I guess in a step family situation that's possible. And the most important is the residency test, where the taxpayer must have the child living with them for more than half of the year. A qualifying relative also has to be related, I'm not going to read you all those categories, and must also live with the taxpayer more than half the year. In order to qualify as a dependent, the gross income for the year must be less than $4,300, but this does not count Social Security benefits such as SSI, and the taxpayer must provide greater than 50% of the relative's support. This is, okay, here we have an example. If a taxpayer claims their parent as a dependent on the 2019 tax return, the taxpayer did not receive the $500 first payment or $600 second payment because the parent is not a qualifying child under the age of 17. When the parent, that meant that the parent could file, since there was no economic impact payment for them, they could file a 2020 tax return and get the 2020 rebate recovery credit if it's just one parent, the $1,200 plus the $600, $1,800, as long as the original taxpayer doesn't claim the parent as the dependent on the 2020 return. Okay, the taxpayer or the parent would get the third payment depending on who claims the parent. So even if you continue to claim the parent, it was a toss-up. If the adult child who claimed the parent continued to do so, because they changed the criteria, they could get the $1,400 payment, even though they didn't get the first two payments. But economically, it worked out better for the family as a whole if the parent claimed themselves in 2020, because they'd get $1,800 versus $1,400. Now it's very common that there are competing claims where that's where one person or more than one person tries to claim a child or another person as a dependent. It is only possible for a person to be claimed as a dependent on one tax return. They can only be a dependent of one taxpayer. If a Social Security number is used more than once, the IRS is going to reject the last electronically filed tax return. And most tax returns are electronically filed now. That's what's recommended. But there was a lot of confusion because people come to the clinics all the time saying that the IRS rejected their tax return, even though they are the legitimate parent to claim the dependent. The rejection when there is a second claim of a Social Security number is not a legal determination of dependency. It is a technological reject, and that just means that the computer has said, oh, we already got the Social Security number, you can't, this return will not go through. But it is still possible for the taxpayer who legitimately can claim the child to file a paper tax return and claim that child as their own, and that will then generate an investigation by the IRS to determine who is supposed to be the parent who claims the child. So if someone has this problem, we always tell them, you need to just file a paper return and claim the kid. Don't just let it go. I've had taxpayers who just want their refund money very, very quickly, and they have been known to like take the child off the return, but they're really kind of cheating themselves out of extra money. Okay, it is possible for there to be a qualified child of more than one taxpayer. And I will point out, I'm dwelling into this because this is going to be really relevant when David starts talking to you about that child tax credit in a couple of minutes. So that's what's kind of important to know who the right person is. Okay, if you had, there are a lot of blended and multi-generational families out there. It is still required to claim someone that you have a relationship. But if there is a relationship, the natural parent is always going to take priority over the other people in the household. The residency custody, if there's a dispute, the person with whom the child spends more nights during the year, and since there's usually 365 days instead of leap year, that really is something that can be determined. And if it's equal, the parent with the higher income is generally the one who is allowed to claim the child. Residency is the primary factor that makes this determination. Okay, so we have an example. You have a daughter and she's your qualifying child for you, and you are living with your mother, the child's grandmother. Okay, she could be claimed by either person, but under those rules, you are the one entitled to treat your daughter as the qualifying child for all of the tax benefits that you would qualify for. Your mother can only take tax benefits if she has a different qualifying child. But if your mother's adjusted gross income is higher than yours, you are allowed to let your mother treat your daughter as her qualifying child. But if you do that, you don't get any of the benefits. So again, we've got that the one Social Security number per being used, and that's it. And I know this is a little confusing, but this is something that we do see all the time. And unfortunately, we see it frequently where people are claiming the kids without the parents' permission. But the IRS has now become very, very strict that if somebody is going to be claiming someone who's not there, for whom they are not the parent, they are requiring that a special form be filed with the return to prove the eligibility to claim the child. Next slide. Okay, so now our most common situation now is the children of divorced or separated parents or parents who live apart. Usually the custodial parent, and that is the parent with whom the child lived for the greater number of nights during the year, gets to claim the child for all tax benefits, unless the custodial parent agrees to let the other parent claim the child and gives the other parent a written declaration, IRS Form 8332, that specifically allows the other parent to claim the child. This went into effect. This has been enforced. It started with the 2018 tax filing season. I have had people yelling at me when I work on tax returns saying, I've never had to have that form. I'm like, yes, well, there was a new law. I'm sorry. Remember tax reform? Well, this is part of it. Go get the form or I'm not filing your return. But this was done to make administration easier for the IRS so they can figure out who the right person is. And this way, the main, it's like if the child does not live with the taxpayer, they better have that form or they're just not going to accept it. Okay, so the economic impact payment versus the rebate recovery credit. They're sort of the same thing, except when they're not, all right? The authority to issue the first two economic impact payments expired on December 31st of 2020. From 2021 forward, the only way to get the EIP is to file a 2020 tax return. It is still not too late. You can file your tax returns for 3 years. The best thing to do is to file electronically, but the IRS starts switching over its computers October 15th. But there are some places though that can still do electronic submissions that will get processed, but that is the only way to get this money. When the joint economic impact payments were issued during 2020, the IRS treats each spouse as receiving 1/2 of the joint EIP, even if the entire payment went to one spouse's bank account and the other spouse did not receive their share. So I can feel all the family lawyers listening to this nodding their heads because they have had so many complaints about this. But sadly, the IRS, if a joint return was filed, upon which the IRS relied, they are not assisting taxpayers with getting their share of this joint refund. They view that as a purely family law issue, and you need to go to your state court to do this. I know from our family law practitioners, it's money, it's time to get into court. The family law judges who do support orders, if have been fairly sympathetic to this situation. So if you are trying to get child support for your client, it's a good idea to also request the share of the EIP to which your client was entitled. And you have to educate the judge on what that is. And you can, if you have an LITC, you can talk to them, or you can call one of us and we will be happy to coach you through this. But the family court judges in our jurisdictions have been issuing court orders when they find out that the non-custodial parent walked off with all this money. They are putting in the child support order that this payment also has to be repaid to the custodial parent. Okay, so if you have your prior joint returns, if the taxpayer agreed to file a joint return and the spouse received the entire EIP, RRC, the IRS is not going to issue another payment, all right? If you have a separating divorcing spouses, you can treat it as an equitable distribution issue, which legally is technically more correct. But again, as I said, some judges are amenable to putting it in a support order. But in those situations, which we all see all the time, where you have one taxpayer just using the spouse's social security number and just sticking the money in the computer and filing it without the spouse's consent or authorization, the IRS has worked with people to fix that. And they will agree to that if the taxpayer files what's called an identity theft affidavit and the form number is 14039, where they are swearing that this is not their tax return. They had nothing to do with it. They didn't authorize the spouse to use their information. They didn't authorize the spouse to use the kids' information if the kids are living with them. And the IRS will investigate that situation and will consider issuing the proper refund directly to the taxpayer and then going back to the person who improperly used the Social Security number and demanding the money back from them. So that's the remedy. But again, I just have to emphasize, if they voluntarily did joint, you got to fix that in family court. But if somebody stole the Social Security number, that's when we can work with the IRS to get them help. I'm always, David is nodding, and that always makes me feel good that I'm nailing it. Okay, good. I'm glad he agrees. Okay, next slide. Okay, that's it. Okay, as long as the taxpayer claiming a qualifying child meets the eligibility requirements, the taxpayer can always claim the rebate recovery credit on their 2020 return, even if someone else claimed the child in 2019 and they received the first and second, the other person received the first and second economic impact payments that included amounts for that child. Those of you who do family law, I'm sure you have seen it's been a very common thing for many years for property settlement agreements to say, you take the kid 1 year, I take the kid the next year. That is now that is going to become a logistical nightmare under these programs because everything is based on the prior year. But if you say, if in 2019 the father was allowed legitimately to claim the child, he automatically got the 2019 payments. All right, and that is fine. And that, remember, basically the IRS was not making him pay that back. That does not prevent the mother who is claiming the child in 2020 from getting these payments, because they are legitimately claiming the child for 2020 and they are, it's the proper dependent. They are allowed to get this money. Now, the IRS has been trying to ferret out fraud with the economic impact payments, and they have been requiring a lot of identification verification. And when you have the switch off of 2019, 25, if you have every other year, it's going to slow things down for the parent. And I recently was talking to a private divorce lawyer who I had recommended to his client who just called me because he wouldn't give her tax advice, so she called me. And I explained this logistical nightmare because they were doing the switching thing. And I ended up, by the end of the conversation, I had him convinced that family lawyers should stop doing this, because the way the tax law is with the IRS having to take care of all of these, the child tax credit and becoming the new welfare agency for putting out these tax benefits, they're just creating nightmares for their clients to have it switch. And you're just better off figuring out some other way, some other financial way to balance things out, because this is really, it's made this program, even though Congress and the IRS are doing the very best they can to get the money into the right pocket, with having things switch back and forth, they're almost guaranteeing that that's never going to happen. Okay, so the electric filing, I keep putting 2020 instead of 2021. The electronic filing for 2020 ends 10/15/2021. That's if you use the IRS free file system, but it is not too late to file the tax return to also claim the rebate recovery credit until 3 years after the due date of the return. And since we had an extended due date due to the pandemic, that means people can claim that who didn't get their stimulus payments have until May 17th, 2024 to claim these credits on their tax return.
Nancy, I think that's a really good point, that the practitioners, no matter what the area they're practicing, can let these people know it's not too late. A lot of people think they've missed out.
They have not missed. Absolutely. Absolutely. They can still get the money, and we want to make sure that they do. And, it's I don't want to trample on David's part of the program, but there is a new portal for child tax credit, and people who have not done anything to get the economic impact payments, if they use that portal, they will get all the economic impact payments to which they're due when they put their information in that portal going back, which I'm very proud of the IRS for doing that. You know, that's a real bonus. Okay. Now, something to do, especially for if you want to make sure that nobody uses yours or your child's social security number going forward, last year the IRS expanded its identity protection personal ID number program that was set up originally just for people who were victims of tax fraud. The IRS will issue people who request it a personal ID number, a 6-digit number that has to be put into the computer before a return can be electronically transmitted. So if you apply for a PIN and you get it and your ex-spouse or your estranged spouse tries to use your social security number, the return will not transmit. If they are claiming a child that they're not entitled to claim and you've gotten the IP PIN for that child, the return will not transmit. So our family law section at Legal Services was delighted last year when I told them that to get all their clients to go online and request the IP PIN for themselves and their spouse or dependent or whoever they're claiming on their return. They can do this, and they have to do this every year, but it's worthwhile because it protects their own social security number. I'm having people start to apply for them now. It is possible. You don't have to do it in January. They don't issue the PINs until December or January, but you can go in right now and start putting in the application for yourself, the PINs, or your clients can do the same. But it's very important to spread the word about this program, because especially with the child tax credit now becoming a big thing, this will definitely help get that money into the proper hands. Okay, I think now I get to segue to child tax credit, David. So,
Thank you, Nancy. Yeah, a great presentation. And one thing I do want to mention before I move on, and it's going to affect this too, a lot of times when someone gets a return rejected when they're trying to do it electronically, that's usually indicating that something's gone awry. Either somebody's doing something nefarious in like a domestic violence situation. But when the remedies for those a lot of times are through filing paper returns, the old school way where you put it in an envelope and you mail it off to the IRS. Well, the IRS, if you're following any of the commissioners' press releases, you will see how far backed up they are and how much they're struggling with the paper filings. So please let your folks know that this is not a fast remedy. There is a remedy, but it's super slow, the backlog is huge, and it does take quite a while. But there is a way of getting it. It just won't be fast. So yeah, let's move on to what so far has seemed like a really good thing, but I think all the practitioners at the clinics that are like ours are very nervous about is where the IRS is now getting into the world of monthly disbursements of poverty relief. The goal is to reduce child poverty in the U.S. by providing these stimulus to middle and lower income families. But they were doing it very quickly and off their own bat based on things that were filed in the past. So the child tax credit is available for all individuals and married couples who file jointly with dependent children. As part of the American Rescue Plan Act, the credit has been expanded and enhanced to include advance payments. The child tax credit is not new. It's just the way that the IRS is putting it forwards is different than before, and we'll get more into the changes. For now, the changes are currently through the end of the year. There is a big push for this to be extended. The president wants it through 2025, but we'll see what happens, going forwards, at least into 2022. But going forwards, we'll see what happens. All right, does my child qualify as a dependent? Once again, another rule based on another credit. So one tip for people who are not tax lawyers, look at these credits one at a time. So the earned income tax credit has different rules than the child tax credit, than the RRC. So every single one of them needs to be looked at, and the analysis needs to be gone through it the same. A lot of them look the same, sound the same, but there's some slight differences. This year for the child tax credit, they've switched it back up to 17 years old at the end of December 31st, not 16 like it was in the past. That means if that child turns 17 anywhere, even on December 31st, that will work for that child. It has to be a legal child, stepchild, eligible foster child, sibling, all of those usual things you see. And then they have to provide for less than half of their own support costs. They have to live with you for at least half of the year. Once again, we're now into that minefield of shared custody and looking at those custody agreements, and actually where the child is for has to be over half the 365 days or 366 days in leap years. And U.S. citizen with a social security number. We'll see there's a little bit of nuance with that part. All right, so the expansion of the child tax credit. So there is quite a large monetary expansion. In the past, the CTC was 2,000 with 1,400 being refundable. Now we're in 2021, we're jumping way up. That's why everybody's so excited about this. 3,600 per child age 5 and under, and 3,000 per child 6 through 17. So you can see, like a family of 5 children, you're talking a good chunk of money coming at you this way. There's no income requirement, so even if you aren't earning, you're still going to get this, because remember the goal, it's a child stimulus, it's not a parent stimulus. So that's why they're not so worried about the income. But there is an income phase out as for people that earn more money, but we'll get to that. All U.S. residents with eligible dependent children qualify, which is a good thing. All right, so a little bit of recap. The credit does not count as taxable income. It's now available for up to 17-year-olds. So that's a great one more year for some of these children. The credit is fully refundable, not partially like it was before. And that means you can receive this money whether you owe taxes or not, similar to their earned income tax credit. All right, so what is the advance? So most families who qualify for CTC will automatically begin receiving advanced monthly payments on July 15th, so most people should have already been getting these. So based on the information from the 2020 tax return, 50% of each child tax credit will be paid out as an advance before December 31st, 2021. So 1,800, which is half of the 3,600 mentioned before for children 5 and under, and 1,500, which is half of the 3,000 for child 6 to 17. So that way, even if the IRS gets these numbers wrong, it's still only half of the credit. So you might be able to do some fixing of that later on with your tax return. So monthly installments. The advance will be paid monthly through December of this year, and then we're waiting to see what's going to happen going into the next year. So people may be already starting to feel like that this is part of their budget, and it may be going away or may not be. We're still waiting to see, and we'll keep you updated on that. Those who have filed their 2020 taxes will receive $300 monthly for child's aged 0 to 5, and then $250 monthly for the child 6 through 17. 6 of those through through 2021. So what do I need to do to get the payments? Well, a lot of people have to do nothing. I started receiving them from my children, and I didn't do anything specific other than file tax returns. So if you filed 2020 or 2019 and claimed the CTC, you have to do nothing. So if everything is the same, you should start getting it. If your life hasn't really changed since then, you'll get your payments automatically, direct deposit or through the mail. And depending on how you had set up your refunds in the past. If you normally owe, then you probably will be getting it through the mail unless you go and provide some updated information. If you're required to file a 2020 return and you haven't done it yet, you do it now, preferably electronically with direct deposit. Like I mentioned before, the IRS is very backed up with the paper returns, so it's much better when you can get your information electronically into the system, which is much faster. If you're not required to file a return and did not file 2019 or 2020, then the IRS has set up the non-filer portal, which I'm going to talk about in the next slide. If you've had changes in your circumstances, there is a CTC update portal. So say if you had a child was born since the last time you filed a tax return, that's where you would want to go into here and get that child put into there so you can sort of see the difference. So. All right, for those who aren't required to file, you can use the non-filer tool to submit a simplified tax return. Once again, we're getting back into the IRS internally only has certain systems for doing things. And during the stimulus payments, they kind of decided that the only way that they could really do these non-filer things is to create a simplified tax return. So it is a tax return. So if you go to, say, in those situations where you're in a custody or you're in a divorce and your custody battle and your spouse has already filed some sort of return with the information on it, with your information, you may not be able to. This may have caused problems for you. But this is the link where you would go to that non-filer tool to be able to submit this. The IRS learned a lot during the stimulus payments. So I'm seeing actually a pretty good success rate. Yesterday, I did hear a really sad story where someone ended up getting into the wrong part of the IRS. They were not very computer savvy and ended up paying $1,400 to the IRS, thinking that they were going to the non-filer portal. They ended up putting their bank account information and ended up making an advance payment to the IRS. But that's a rarity. For the most part, people are able to get through this. We actually help a lot of folks over the phone through this, and it works pretty good. It's really not that hard to do. As long as they have all this information down below, full name, mailing address, email address, date of birth for everybody, social security numbers for everybody, ITINs and cell phone number, which is recommended. Pretty much everybody now has a cell phone. You may be dealing with some home challenge clients that may not have a cell phone, but even then, they tend to sometimes have that capability. So, all right. Do I need a social security number? Well, because of the litigation over the stimulus stuff, it's pretty. The government's taking a pretty broad stance on this now and allowing ITINs to be used. So as long as the parent has either a social or an ITIN, you're okay. The dependent child must have a valid social though, so to be claimed. So the parent's okay to have an ITIN, but the child must have a social. To obtain an ITIN, the form is W-7. That's the initial application for an ITIN, and a renewal application is a similar process if that's needed. All right, so where will my parent payments be sent? I mentioned before that they kind of will look back at your last tax return to figure out where you're going to be sending things unless you use the portals to update your information. They'll be sent to the bank account or address on your 2020 tax return or through that you provided through the non-filer tool. The IRS computer will automatically determine if you've received the correct EIPs or RRCs and send the money if you have not. That's Nancy mentioned. That's a great thing that the portal that they're using for all of these is kind of having the effect of fixing the stimulus while you're even trying to work on your CTC issues, which is great. I'm a little bit less willing to give the IRS credit for being brilliant on that one. I think that's more of just a happy accident where the taxpayers are getting a benefit on that one. But that's me being cynical, and I apologize. You can update your bank account information on the CTC portal, but like I mentioned with our sad case yesterday, please make sure that your clients are in the CTC portal, not the I want to make a payment to the IRS portal. So they'll give away their money rather than get the money. You will need to provide routing numbers and account numbers, so make sure that folks know where to get those and how to provide those. This is the fastest and most secure way to get your tax refunds through EIP payments and the advanced child tax credit payments. So if you do not have a bank account, you can elect to receive a prepaid debit card in the mail. As you know, receiving any card through the mail has its own sort of pitfalls and minefields. But if that's the only way to get it, it's pretty safe. We haven't had a lot of cases where there's been issues with that. So.
Can I interject something here, dear?
Yeah.
A lot of people who are on any sort of public benefit, whether it's federal or state, who get their benefits through an EBT card, who already have one, like a SSI or SNAP, there's an 800 number on the back, and if they call the 800 number and give them their card number, they can get the routing and account number that would be put on the return, so that the whatever money they're getting, their RRC or whatever, or the child tax credits, can be put directly on their existing EBT card. But they have to call and get the bank information, and people don't realize that, but it's work that's very, very convenient for people.
Yeah, that's not widely advertised or promoted, but it's much safer than having debit cards floating around in the mail, especially
Right.
if the person doesn't have a very safe address.
Right.
All right, so if you have no permanent address, like I just mentioned, you can list a friend, relative, spouse, or trusted service provider, such as a shelter or a church that you're working, the person's working with, on the information you provided the IRS. You need to know, if you do that, though, that's going to be where other things get sent from the IRS. That won't be just for the one thing. So if that wouldn't be a problem if this is the only thing that's going to be coming to you, but if the person doesn't want to be getting all of your IRS mail, and you may not want them to be seeing all of your IRS mail, so just let them know that. You need to live in the U.S. or U.S. territory for at least half of 2021. This will include all of the usual exceptions for military service, things like that. And if you're unable to set up a direct deposit, physical check will arrive in the mail. And it's quite a nice thing to see when that thing pops in the mail and you're not expecting it, which I think a lot of people were surprised when it came so quickly this year. So, all right, so how does the IRS calculate my payments? So they'll automatically calculate how much to send each family based on your 2019-2020 returns or the non-filer tools. So if you haven't actually gone to the non-filer and told them about a change in circumstances, such as maybe the death of a child, or having another child, or having someone else other than you looking after your child, say you're incarcerated, then things maybe not be getting calculated as correctly as they are. That's what some of our concerns are, but we'll get to that more when we get to the portals, the updated portals. If you're scheduled to start receiving payments, the IRS will send you a letter 6417 to the address you have on file. I saved mine. I thought it was quite nice to get that letter. And you have to look at that letter, though, to make sure that letter was accurate. But if it's not, you have the portals to be able to correct what's going on. Tells you the amount of your monthly advanced child tax credit. And if your 2020 tax return is processed after July, which is the case for a lot of folks who file extensions, the monthly payments will be adjusted so you receive half of your CTC before December 31st, 2020. So things are going to be adjusted a lot, which I know provides all of us on this talk today with some concerns when the IRS is automatically adjusting things for your life and you're not involved. So, but so far so good. I'm not gonna bash it till I see any major problems. So what do you do on the portal? So you should go and check your CTC status online, and that'll see your payment schedule. You can update your information or unenroll. I'm going to talk a bit about unenrolling because it's going to be very important, especially in family law situations. So you can update or unenroll from the advance payments on the portal. If you do not have a qualifying child in 2019-2020, but you will claim one for 2021, let the IRS know via the portal. That way they can change your circumstances so you're getting the correct amount. If you haven't already, you need to create an ID Me account, which I've heard is fairly straightforward. I haven't done a lot myself. Nancy, have you done those?
Yes, I did, and I am a technological boob. It took me about 20 minutes, but anybody under the age of 60, I'm sure, could do it in 10. Okay. What it does is you have to scan in your a photo ID, And then have your computer or your iPhone or whatever take a picture of you, and they match you up with your ID to make sure it's really you. And they have, I mean, you have to put in other identifying information like your social and all that. But then once you get your number, that's it. And I think it's going to be the wave of the future. Even with IRS, I mean, obviously they're using it now, and I think they're recognizing that in the past their identifying criteria are a little bit difficult. You know, I've never been able to get an IRS account because they keep insisting my cell phone is not in my name, even though it is. But I think this is going to be something that the federal government and even state governments use uniformly, and it really was much easier than getting an IRS account because I don't have one, like I said, but I've got an ID me. I'm good.
You know, that's quite funny because I don't either, because of the same reason. The cell phone accounts seem to be one of the things that really trip people up. That's great to hear. I'm looking forward to trying it out, and I'm sure I'll be in the 20-minute category, not the 10-minute category as well. So if you wish to unenroll and are married and filing jointly, each individual will need to unenroll themselves. It's not going to be a blanket unenrollment. Unenrollment may be a very important thing to be doing if there's a change in circumstances, and also in the past, if the family has filed a form 8332 where they're sharing custody, and they don't, you know, each year there's going to be if this keeps going all the way to 2025, every year they need to maybe go ahead and get rid of that 8332, and where it's not switching between the spouses, and then have the person that's not supposed to be receiving the money unenroll so that it's going to the right spouse. There's going to be a number of situations like that, but it could almost be a monthly switching back and forth if there's a lot of fighting in divorce court going on. So yeah, there may be a need to go back and unenroll and roll different people at different times. So, but like Nancy said, I like that idea of having, just set up the tax part one way, and then have the divorce court decree have some other enforceable mechanism for dealing with these payments, because dealing with the IRS does not really care very much what your divorce decree says. Actually, they don't really care about it at all. So so that's one thing that people are not understanding all the time. All right. So another thing that I was very scared when I saw this were coming out were these dates for updating information. There was different things that were supposed to be updated each one, but so far so good. I haven't seen too many problems with these. So these are whether you're going to be stopping payments or changing bank accounts. Like, say if your bank account was compromised, or it was in your previous spouse's name, you want to get it going to your bank account. These are the dates that you need to do that before. So so far so good on these. So the portal should be able to help you do what you need to do by each of these times. But we'll see how it goes. Still got a few more months, and then we'll see how it goes once we start filing tax returns based on these numbers. All right, so this is the creating the irs.gov and an ID me account. On the CTC update portal, taxpayers and eligible CTC recipients may need to create an ID me account through irs.gov to verify and protect your identity. It's a trusted credentials service provider selected to support irs.gov login services. Now, depending on how skeptical your client is, this is, so far, I've never heard anybody complaining about anybody hacking this or getting this information stolen. So, but everybody has their own opinions on that. But so far, I think this is pretty much the safest way to get your information in there. And like Nancy said, it was, even for those of us who are technologically a bit challenged, it seems doable. So it uses the latest in identity verification technology to authenticate your identity, which is great, rather than using your cell phone account, which seemed kind of absurd. So, all right, so concerns about sharing your information. The IRS is governed by some fairly strict confidentiality laws in the Internal Revenue Code, and as lawyers, you all know the quelling effect of agencies sharing their information between each other, whether or not they can get their jobs done. So for the most part, the Internal Revenue Code doesn't really share. And that specifically for those of you working on issues with non-residents and in immigration, you would be worried about ICE being shared information with. We've never experienced that, even though we've been very careful to watch how that was going, especially in the last administration. But yeah, unless it's like to the level of terrorism or criminal fraud, then pretty much the IRS does not share any information with other agencies. Generally, the IRS is not allowed to share information from a tax return. That's very strict about the sharing of federal tax information. So you're never going to be able to satisfy the concerns of every one of your clients, especially those very, very concerned people that really tend to be very skeptical of anything government related, but for the most part, people should be able to rest easy that we're not going to share information. Community Tax Law Project deals with a high number of immigration cases, related cases, a lot of undocumented cases, and we have never had an issue in this area. All right, are they subject to garnishments? So this is one area where over the last 2 years, a group of taxpayer clinics and various tax lawyers and other outside groups have been doing a lot of litigation, a lot of push for litigation to sort of get this stuff where things aren't happening. And nice to see that the IRS actually played nice and actually is not allowing this money to be offset to all over the place for different things. So this is similar to what Nancy mentioned for the RRC payments. They will not be reduced or offset to overdue taxes, because remember the goal of this is money to go to children. It's not for go to the paying of the penalties of their parents in the past. So no offset to overdue taxes for previous years. Remaining CTC credits will be subject to offset for 2021 tax obligations, just like they would be. This is the child tax credit, even though they're giving part of it in advance. The other part of the credit is still works the way it did before. Advanced child tax credit payments will not be offset to past due child support, because that would make no sense for the purpose of the bill. Advanced child tax credits are not exempt from private creditors, but Virginia has moved to protect these payments from private creditors. So that's a nice thing. Not all states may be the same. So if the person has a problem from out of state, but they're for some reason working with you, make sure that they're wherever they're whatever state law is going to affect the private creditor, that may not be able to get that protection if they're no longer in Virginia. Since these payments are not income, they will not affect any government benefits you receive. So that's great. No one's going to lose their other benefits for receiving this money. This is just a boost, so which is excellent to see. All right, will I have to repay if the IRS sends me excess payments? The general answer is yes. If the total amount you're paid is greater than the amount that you're allowed to claim on your 2021 return, you will have to repay the excess amount on your 2021 return during the 2022 tax filing season. This is going back, we have to go back and look at unenrolling. So if you are no longer should be receiving any of these payments and are not going to be claiming any of your children on your 2020 tax return, you should go about quickly unenrolling so that this doesn't put you in a position where you actually owe rather than are getting the benefits of the credit. But like I mentioned before, this is an advance of half of the credit. So even if they were giving you a little bit too much, but you still should be receiving some of the credit, you may be okay, but you have to take a look at that. And people should unenroll when they're supposed to unenroll. So if they're no longer involved in the child's life, they shouldn't be getting this money. However, if you qualify for full repayment protection, if your income is below a certain thing, so they know that the IRS and the federal government started giving these payments automatically. They didn't ask if people wanted them or not. So they basically were like, okay, well, in certain situations, we're going to have to take a look at this. And these groups of people down below, $60,000, if your income is $60,000 or less, and you're married and filing jointly, you will not have to do full repayment. 50,000 if you're filed head of household, and 40,000 if you're a single filer. So that should alleviate a lot of these problems where people have got the money, spent the money, and then find themselves in some hot water because they shouldn't have received all that money. Does it get phased out if I earn too much income? The answer to that is generally yes. It's a modification just like it was with the stimulus payments. It's a different calculation though. So the maximum credit is available for people up to 75,000 or less for single filer to married persons filing separate returns. 112,500 for heads of household, and 150,000, which is 2 times 75,000 for married filing jointly couples, and qualifying widows and widowers, only for the certain period where they are considered qualifying widows and widowers. The CTC is reduced then by $50 for each thousand by which your AGI exceeds these income thresholds. So the person needs to take a look at that. If they've actually got a better job in 2020, in their base, or 2021, I should say, and their 2020 income was allowing them to qualify, but now they would be phasing out. You need to start looking at these numbers and see which way it will work. All right, here's some helpful resources. So there's a lot of information on the portal on irs.gov, Consumer Finance Protection Bureau step-by-step guide, White House Child Tax Credit. The cool thing about this credit and the way that the administration is doing it is the White House got directly involved. It was really amazing to see not only information coming from the IRS, but coming directly from the White House, which is shows how much this credit program is a baby of the current administration. So they really want this to work. So they're putting it even in-house. The White House is giving guidance. Another IRS guidance there, FDIC is providing some guidance, EITC Outreach, CTC, and then Get CTC. And as always, you can contact your local low-income taxpayer clinic. And we have two of the 3 Virginia clinics on the call right now, and there's pretty much a clinic in every single state, and then in certain metropolitan areas such as New York City, there's a number of depending on the population. So yeah, if the person's calling needs help in North Carolina, there's going to be a clinic there. So. All right, I'll now turn it over for the remainder of the presentation. Thank you.
Hello, I'm going to talk about the COVID-related tax law changes. This will affect the tax returns for 2020 and 2021. And for those people who haven't filed a 2020 tax return, this is good information for those to have. So the first tax law change we're going to speak on is charitable contributions. This tax law change happened this past year for 2020. You can deduct up to $300 of contributions to qualified organizations. This only includes cash contributions, and this can only be used with the standard deduction. Just as an example, as far as what type of charitable contributions the IRS will consider, this is contributions in cash to different organizations and also churches as well. So this is one COVID-related tax law change that they have implemented. Now, with the earned income credit, due to a lot of people, our taxpayers who have lost their income in 2019 and maybe had a decreased income in 2020. So depending on what happened with their job situation, in order for people to get the earned income credit, if the earned income for 2020 is less than 2019, they can elect to use 2019 earned income to determine 2020 earned income credit. We do not know yet if a version of this will be extended to 2021 due to the continuing pandemic, but hopefully it will, because again, a lot of people are still on unemployment and still not out of work. So we'll see if they do extend this particular benefit. Now we're going to move forward to people who are self-employed. First, with self-employed paycheck protection plan, those who are self-employed are eligible for these loans. The loan is to cover lost profits for the self-employed. This is a forgivable loan, and you can deduct ordinary business expenses paid from the loan. So this is a really great incentive for people who are self-employed. Also, if you are self-employed, between March 27, 2020 to December 31st, 2020, you can defer the employer portion of the Social Security tax on income. This can be claimed as a refundable credit, which is really great. 50% of the deferred amount is due by December 31st, 2021, just as a reminder, by the end of this year. And the remaining deferred amount is due by December 31st, 2022. And moving on, for those who are self-employed, I'm going to talk about the sick and family leave credit. This was extended to March 2021. You can receive both credits, so you can receive both the sick leave credit and the family leave credit. In order to be eligible for the sick leave credit, you're not able to work due to COVID or had to quarantine, or you're not able to work if you had to care for someone who had COVID, who had to quarantine, or the child's school was closed due to no child care provider due to COVID. In order to be eligible with a family leave credit, you're not able to work due to having to care for a child whose school was closed due to COVID, or there was no daycare provider due to COVID. So you are allowed to claim both of those credits if you're eligible. You're eligible to claim both of those credits, excuse me, if you fall under those eligibility requirements, and that was extended until past March 2021. And then just to go back for the self-employed, I think, as far as a lot of attorneys up here are not tax lawyers, this would be really good information to know if you are dealing with child support issues and you're looking at opposing parties' tax returns. This would be good information for you guys to have, just to look and see what's going on with the tax return and why their income is the way their income is. So that's really good information for you guys. And next, we'll move on to retirement contributions. As of right now, there is no age limit. And in order to determine income, they will include taxable alimony, taxable non-tuition fellowship, and stipends, and Medicaid waiver payments are accounted as compensation right now. And for those who don't know what Medicaid waiver payments are, they are non-deductible. They must be from the employer, and these are for people who are taking care of someone, and they're allowed to get these payments. And then with retirement early withdrawals exemption, in order to be eligible to be exempted from, being charged the 10% penalty, the taxpayer or the family member who has had COVID or who had a financial consequence due to COVID, the distribution must have been done prior to age 59 and a half. I do know a lot of people due to COVID had to, and the loss of their jobs, had to get money from the retirement account. So this is a great benefit. You could withdraw up to $100,000. As I said before, you will not be charged a 10% penalty for early withdrawal, but you are still required to pay the taxes, and the early withdrawal could be spread out for over 3 years. And then with retirement minimum distribution, for this new COVID tax-related law change, the taxpayer can skip tax year 2020, and then can now start at age 72. And then with qualified charitable distribution, now you can start at the age of 70 and a half, which is a really great benefit. So that's the end of our presentation. If anyone has any questions, we are more than welcome to answer them. And thank you guys so much for being a great audience. And if you have any questions, just let us know. Thank you.